a follow on X. He is Mike Fairborn CS. I am Rachel Dash CS. We both post tons of updates, charts, and market commentary. Now, today, please feel free to give this video a thumbs up if you do like the video. It helps other subscribers and other traders find this content as well. And please feel free to subscribe to Trader Talks on Schwab Coaching. Now, today, we have had some major headlines surrounding semiconductors. Everyone has been watching a lot of the price patterns unfold in the overall market. You probably noticed a lot of possible topping patterns that have developed. So today, I know we've focused on this topic before, but I think today we're going to spend a little bit more time on talking about failed patterns and how to trade those. So I'm excited to dive into some of that material, but first let's get started with some of those important disclosures here. So options carry a high level of risk and are not suitable for all investors. The information we're going to cover today is for informational and educational purposes only and should not be considered any type of recommendation or advice. And we are going to go through the Paper Money software application. Keep in mind that there are some differences between paper and live. Now, for our agenda, we are going to start with our market overview. We always start by looking at some of the major market indices. We're going to review our past trades, place new trades, and walk through our trade management. So let's dive into Thinkorswim, and let's just start with that view on the S&P 500. Okay, so few weeks ago, we have had this triangle consolidation. We had a break of that consolidation, a little bit of a retest, some time spent above it. And now we got that other retest again this past week and this week so far. And it seems as though price is following its 50 period moving average. So since recently testing it, and it's tested it a couple times, but it's been met with buying pressure every single time. You can see that it's been met with demand. It hasn't spent really more than 3 consecutive trading days below that 50-day moving average. And right now it looks like we have reclaimed it the last 2 days or so. So the trend is still your friend. The trend is still to the upside. Obviously, the 200-day moving average is well below. That's why I didn't even show it here. So the long-term trend is up. The intermediate term trend is up. The thing that you may want to watch here is this curvature of this 50-day moving average, because sometimes we can see that price has been a little bit choppy these last few weeks. We just got out of that major triangle consolidation, but sometimes you can spot a little bit of a smooth trend change by looking at that slope of that 50-day moving average. So if that starts to arc over a little bit, you may want to keep a close eye onto price in that case. But right now, market breadth looks strong. The S&P 500 still looks strong here. Obviously, we have a couple different Mag 7 stocks reporting earnings. We have a little bit of kind of heavy weeks of earnings and things like that. But I wanted to also introduce you guys to the average directional index, if you guys have heard of this indicator as well. Now, this is one I personally look at a lot, because when we're looking at the trend, this average directional index is a trend strength gauge. So when you have peaks and troughs in this average directional index, it's going to tell you a little bit about the maturity of that trend. So typically, when you have these peaks in the ADX, they often coincide with peaks or troughs in prices. You could see that with the last time that we hit those March lows. You're also seeing that we've kind of reached this trough in prices now. And this trough in prices has been telling us, hey, the market's become a little bit dormant in the S&P 500 as a whole. It's become a little bit trendless, but once this trend gauge starts to turn up, that's telling us that the market is going to accelerate in a trend direction. Now, this doesn't tell us which direction that the trend could accelerate in, but since we know that this S&P 500 has been above its 50-day moving average, if this starts to arc up, if we get a little bit more buying pressure here, you could say that the trend could be accelerating to the upside. Now, same goes for the downside as well. Obviously, we want to wait for price to confirm. So we want to see if there is going to be a break in either direction here. Okay, so a couple things to watch. Now, something else that has been developing is, since this is a price patterns class, wanted to show you a couple patterns of the overall market. We're going to show you another one that's actually been developing in rates. So I'm going to go to the TNX. We're going to look at the 10-year yields here, and we're going to look at the type of consolidation that has occurred in this type of formation. Okay, and I'm going to take off the trend strength gauge. I'm going to take off the moving average here, and we're just going to talk through what this trend looks like. So up until now, up until this consolidation that I've drawn, we have had quite a strong uptrend in rates this year. We had that last retest at the lows back in February, but nevertheless, a strong trend to the upside. And then we've had a little bit of this consolidation. And so we're going to bridge together a little bit of Elliott wave. I taught on this a few weeks back in the advanced charting class. I have a few different webcasts there, but we're just going to bring some basic principles into talking through what some of these consolidation patterns mean and what they do. So we just saw a triangle consolidation on the S&P 500, where we saw that we had those two trend lines that were converging towards an apex. And so price was getting squished and squished and squeezed by the buyers and the sellers. And as a result of those triangles, you have price volatility in general enter into a squeeze, like you've probably seen in the S&P 500. S&P 500 is at some of the lowest levels, volatility speaking, that it's been, because price has been so compressed in those consolidations. Now, this is what we call an expanding triangle, or some would call it a broadening formation. So it looks like a megaphone. So I guess a megaphone is the last kind of way to phrase this pattern. And these are another version of a consolidation. So just like we saw in the triangle, instead of price getting compressed and compressed, price is actually expanding and expanding, and so is volatility as well. So these types of broadening patterns, you don't see them all the time. They're a little bit more infrequent than triangle type patterns. But on this broadening formation, you could see that price was in an uptrend. It fell down to touch this lower end of this trend line, rallied back up into B, fell again into C, rallied back up into D. And so triangle formations or broadening formations, they're all a version of a triangle. They are a 5-wave structure. So you're going to have a move up, a move down, a move up, a move down, a move up. Okay, so it's going to go back and forth depending on which way the preceding trend was. So this is more of a consolidation or corrective period here. And because volatility gets so high or gets so elevated in these types of patterns, because you can see the range of price is expanding, these patterns specifically are known for false breakouts. So typically you see those false breakouts around that wave D. So this is just kind of to tell you a little bit more about what these broadening formations typically do, since I haven't found any broadening formations specifically in any stocks. I thought specifically since we're seeing higher oil, we're seeing a little bit higher rates, this was a good one to bring it to the table. Beware of false breakouts on wave D, or the fourth wave of any type of triangle pattern, but specifically broadening formations. They are known for these false or early breakouts, which a false or early breakout means that you may see a break of resistance in this case, or even support, before price whips back to the other side and enters into the pattern again. So not to say that the trend could continue up in rates, but just keep in mind that there could be a reversal here, and you could see a lower test of E in that case. Okay, so wanted to spend a little bit of time on those broadening formations here. Let's see. Okay, I had a question. Could this be a reverse head and shoulders as well? This would be a little bit of a quite slanted inverse head and shoulders, where it's almost too much. So I think Barbara is talking about this being the left shoulder, this upper trend line being the neckline, this C wave being the head, and this little section right here being the D. I think it's a little bit stretched, a little bit elevated to be an inverse head and shoulders pattern, but you can see each of these patterns as we talk through them, they're just variations of different types of trend changes. So a pattern is just formed when you're seeing a higher high and a higher low, or a lower high and a lower low that switches kind of gears here. So kind of keep in mind, that's why you'll typically see these patterns may look like other ones as well, depending on where you're drawing those trend lines. Now I'm going to go back to our trades that we have been in for some of these names. Let's just take the time that we have on some of these trades. Okay, we talked about a few of these last week. We still have quite a bit of time. We don't have too much time on these ones. So let's take a look at a couple of these ones. We're going to start with Upstart Holdings, because we talked about if we broke support last week, we are going to close out that trade. And that is definitely what we did over the last week. So we have broke support on this one. That's where we got taken with that false breakout. That's why we want to be aware of those with D, because that was our D wave for that one. If you guys kind of noticed that, that was our D wave for that triangle. They are known for those false breakouts. So we got trapped into a little bit of a false breakout there. Just something to keep in mind. We're going to close out this trade for a loss on this one. So we're going to close out this one. Let's get this to load. And for some reason, this page shows Prudential, but this is our Upstart holding. So we're just going to send that the current price, send that to our price patterns class to try to get an immediate fill. Okay. And then let's see. Okay, so we have one other one that needs to be addressed. I believe that was our Wells Fargo. So we're going to search WFC, and we're going to make that here. And we had 3 long calls, and we're down about $300. We have about 30 days left till expiration, but let's look at the technical setup in Wells Fargo. So right now, we traded this double bottom. Price has just been retesting this level of support. So unless this level of support breaks, which is where we kind of have our stop in place there, or we may not have a stop on this one just because the calls were so cheap. So we don't have a stop on this one. We have about 30 days left. So pretty soon that theta decay or that time decay is going to kick into high gear. We're going to sit this one out one more week. So if we see a break of support here where we break through this zone, that's where we can get out. And we could reevaluate it in about a week. But right now, it looks like it's still holding on to that level of support. So we're going to look to make a decision in our next class, because then our time decay will be kind of speeding up in that case. So we're going to leave those two the same. Okay. Perfect. So let's get to looking at some failed patterns. So we're going to look specifically at semis, because if you guys have noticed, there has been a topping formation in the semiconductor index. And as a whole, there was a little bit of a false break. There was a little bit of a false break where we had one close beneath support, and then price made its way back up. Okay. So this isn't necessarily in the nature of a head and shoulders pattern, but you can see this is a clear-cut line of support that became resistance, that became new support. So clear-cut polarity zone in this case, okay? And so what we're going to do is we're going to look at some of these individual names and talk through these with Micron and SanDisk and a couple others, okay? And we're going to talk about how we're going to trade some of these. So let's take a look at what a failed pattern means. Okay, so we talked before about what a failed pattern is, but we're just going to revisit that again. So let's first look at the structure that we had here within Micron. So Micron formed this pretty big head and shoulders topping formation. You had the left shoulder here at this oval, you had the head up here at all-time highs, you had the right shoulder right here, And then you have this support zone right around, let's say 870 or so. So you had this neckline that was broken for actually a couple days. So you had 3 days of trading or 3 closes below that level of support. So that mixed with the percentage move that it made from that breakdown, that probably would have trapped a lot of traders. And so what we call that, I call it a failed breakdown, but some would call it what we say a bull trap, or I guess a bear trap in that case. So it traps a lot of the bears because you think that you have that confirmed breakdown by multiple closes below a level or a certain percentage move beyond that level, but then it traps traders there, or it just kind of has you, it would be the kind of victim of a failed breakdown where price can then move back above that level of old support, now new resistance, now new support again. So beware of things like this. And this is why, as traders, when we take a short position or let's say a bearish position, so if we would have bought a put or sold a call or went short the stock, obviously there's risks with that as well. We want to make sure that we do have some risk management in place as a trader, especially when we're trading a pattern, because patterns do fail all the time. We know that technical analysis is an art, not a science. And so we know that there's some guidelines around patterns. And if some of those guidelines are not met, then it typically increases the chance of a failed move, a false move, or an early breakout, which in this case, this is what this was. And so as a trader, we want to be cognizant of managing our risk if price moves back into the pattern or results in that failed breakdown or failed move, or what we call a failed pattern, okay? Because patterns that play out are great. Now we always say that patterns are not guarantees to reach the measured objective. They're not guarantees to doing what we think that they're going to do, or what the textbooks say they may do. The market has a mind of its own, but we can actually glean a lot of information from failed patterns, because when failed moves happen and they move back into recapturing that zone that they were in once before, that they were holding above once before, that's telling us that there is quite a bit of pent up demand at those levels and bulls are in control like they were here. Okay, so we had that gap back above resistance in that case, which a gap is really strong. Reclaiming that polarity zone is really, really strong as well. So a lot of the times when we do see failed moves, they may turn into fast moves in the opposite direction. And so failed moves and failed patterns prevent or present traders with some opportunity for trading that directional move back in the other direction of the pattern. So any failed moves, especially in a failed top or a failed bottom, these are reversal patterns turned consolidations. So that's all they are. They're, instead of being a failed top, instead of being a reversal formation, they're essentially then just again one of those garden variety type of consolidations before that next move within that matches the preceding trend. Okay, so that could be what we're seeing here. Now, a couple different things that we could do to trade this. So we want to keep in mind what the volatility environment is like. We have seen that the volatility is pretty high in Micron. We want to make sure that there are maybe no earnings events. So we're going to pull that up so you guys can see that on the chart. To see if there's any upcoming events. So that is one of the other things we'll check as a trader. So we're going to check the volatility levels. We're going to check to see if there is any upcoming earnings or anything like that, which it does not look like there is here on the horizon, since there just was last month, about a month ago. So what we're going to do is we could take a bullish type of trade in this stance, because a couple different levels we could watch. First, we have our resistance that comes at that right shoulder right there. Okay, so that's $1,035 right there. That's our first level of resistance. Now our second level of resistance, it could actually be this gap right here. So I'm going to actually draw out this gap right here on this one. Because gaps always act as a new level of support or resistance if they haven't been closed yet. And so this one has not been closed yet, so that's another level of resistance. And then our prior highs are a level of resistance here. Okay. And then where is our support? Well, we just mentioned gaps. We have a gap right down here, and this would be our level of support here. Okay, so this is the level that we know that needs to hold. That's right above our old topping formation, but this is the level that needs to hold for this not to become an exhaustion gap. Exhaustion gaps are gaps that are filled within a couple days that mark the end of a trend. So we want to make sure that this does not become an exhaustion gap here where it resolves again to the downside, okay? And we can actually notice here that this gap preceding where price retraced was never filled, okay? Before it moved back higher, back into the pattern. So that is telling us a lot about the strength of the trend, a lot about the demand in Micron overall, okay? So a couple things on what we could do. Volatility is pretty high in this name. This could be one of those opportunities where we could possibly sell a put spread. So we could be a seller of an option. If this type of volatility is too high for you as an options trader, because we know with higher volatility comes a little bit higher risk as well. If that is a little bit uncomfortable, what you could do one of two things. You could do a smaller position. So just kind of weaken your position size a little bit, maybe take half of a position that you would normally. So in our case of this account, we started with $200,000. We usually make a trade size of 5%. So we usually put about $10,000 into a trade. So we could go with about a $5,000 trade. So we could just make it a smaller trade in that sense where we're not taking on as much risk. Or we could use a stock trade as well. So a couple different ways on which we can do that, okay? So we can do that in a couple different ways. Now let's take a look at the options market first, because we know that our support is down here and it's starting right around 916, okay? And the market is well above that level right now, but again, volatility is pretty high. So let's take a look at where the market is pricing right around 916, which would give us that short-term level of support. And we're gonna look pretty short-term here. So we're going to look just over the next 2 weeks. Let's see here. Let's look on the 5th of August and let's look at what the options market is telling us. Now, we know that time decay usually kicks into high gear around the 20 to 30 day mark. Okay, so 20 to 30 days left from expiration. So we're still going to get a lot of time decay here. You can see in these options, there's about, close to about $3 in time decay each day. So that's going to benefit an option seller in this case who's capturing that time decay. That's selling at a higher price, wanting that time decay, wanting that premium just to decay away over time to where we can either close it out at a much lower price or we could let it expire worthless. Okay, and so we're going to look at where price could move within the next 2 weeks. So there could be a $174 move in either direction. So that could be one way that we select our strikes here to collect a little bit premium. Now, another way that you could select your strikes is looking at the delta. And so we talked about that gap being around 900 to 916. So that's our level of support. So we could start there with our short option with our put, and we could say we may want to buy the lower strike, sell the higher strike in a case, okay? So that could be what we do. Now, another thing we kind of want to keep in mind too is on some of these options, the spreads are really, really wide. notice how wide some of these spreads are. We want to keep in mind that we want to keep an eye at first the bid and the ask, and we want to make sure we don't sell any options, we don't buy any options that are wider than that 10% kind of zone there as far as our spread, because that's going to tell us we're going to see a little bit of slippage there. So that's a pretty wide spread in that case. The next thing we could look at is volume and open interest, but that's already telling us, hey, we have quite a bit of a spread here with these weekly options, and you're going to see typically less. You're going to typically see less volume, a little bit wider spreads, a little bit more volatility, a little bit more gamma risk in the weekly options. And that's just because they were just offered just a few weeks prior. Let's take a look at this one, which is about 30 days out, the monthly options. Okay, let's take a look at this one. Okay, so that's a little bit tighter in that case with some of these spreads, but is it still going to give us the type of premium that we are looking for? Okay, so this is right around the 30 delta. And this is right below where our gap was the other day. So right below where our gap was, and our 30 delta is telling us that if the price of the stock moves up $1, our option's theoretically going to move down 30 cents or so. It can also tell us that, hey, this could be the probability of that option expiring in the money. So it's still relatively low. Now, a couple of different things we could do. If you do not want to go over a 30 delta, if you do not want to move this tight to where the current price is, where we just had that gap the other day, which would be kind of right around that 915 to 900 strike, we could take it out a little bit further and go down to where we had that neckline support. So we could go a little bit further, and this is right around like 875 or so. 875. Let's take a look there. And we could use that as a level as well. And you can see here, the spreads on these are super, super tight. So let's just say, okay, if we started with an 865, we put a buy order in for that one, and we paired it with the 875. So let's just say we're going to sell this spread right at that level of old support, then new resistance, new support. So right at that polarity zone. That's putting us right at that 30 delta, okay? So this is telling us that the most that we could collect on this option is about $360. So it's the most we can collect on that option. Now, since we're just doing one contract, we are keeping our risk defined. And since we're in a spread, we're keeping our risk defined. And so the most we can make is $360 if it stays here. But the most we can lose is the difference between our spreads, which is our 875 minus 865, so $10, minus what we're collecting on that premium, which is the reciprocal of that. That's $640, okay? So that's our reward versus what our risk there is. So we're still only risking a little bit in this trade. We're keeping it defined. We know we're going to get quite a bit of juice for the squeeze with these premiums because of how high the volatility is, what the implied volatility percentile is in Micron. But Micron has shown that it's reclaimed that level, that polarity zone. It's shown that that level's been tested quite a few times. So we're going to keep our risk defined. Again, the most we can lose is 640 in this case. And we are going to place this trade in our price patterns class. Okay, so we're going to go with that one there. And we're going to hit confirm and send. Okay, price patterns, go to confirm and send. So any questions? Yeah, Chris, yeah, not a bad return to risk on this. Yeah, it isn't bad at all. Typically, when you're selling options, you're gonna see a little bit more of a skew between what you're collecting versus what you're bringing in. One of the major reasons for this is the heightened volatility that we are seeing here. So for some traders, they may say, hey, there's a certain implied volatility percentile where we may stay away from things like this, where you can use other methods like smaller position size, like what we talked about, or maybe using a stock trade, something of the sorts. But that's what we're going to do in this case, okay? Obviously, if we see that our risk is defined, but if we do see that that support level is broken, that would give us an indication to close out that trade, okay? So that's what we're going to do on that one. Okay, let's try to go through one more example like this. We're going to look at SanDisk. SanDisk is the other one as well. Okay, so SanDisk here. Similar thing to what we just saw. We saw 3 closes below that level. We saw a gap up above that old support, now new resistance. And you're seeing 2 power candles today. So you're seeing a big green candle yesterday, a big green candle today. So that's giving us 2 closes above that level of old resistance, now new support. Now, where could be the levels that you target? Well, the first one is going to be this right shoulder, this previous right shoulder. That gives you another $300 to the upside there on that one. If you can get past the right shoulder, you have all-time highs on the horizon for this one. Now, where can you manage your risk? Well, that gap is occurring right at that polarity zone. So that could be a level to manage your risk against. Now, with SanDisk, you do have elevated implied volatility. You do have upcoming earnings in a few weeks. So this could be an opportunity again to do a similar trade as what we just did before, where you're selling a put spread here. You could go long the stock up to here in managing your risk. So it could give you, especially when you're reclaiming this level, this polarity zone here, it gives you a clear-cut level to manage your risk against. And so what we're looking for as traders is, one, we've talked about alignments of time frames, so looking at the longer time frames, piecing down to the shorter time frames. And then also you're looking for a favorable risk to reward entry. So that's the other thing you're looking forward to as well. And so if we enter today on a stock trade and we enter in here, we have 1628 as our entry. We could have this 1490 or 1480 to our downside, whichever kind of range you want to use in the middle there. And then you have your upside as 1952. So a lot of traders could say that that could be a favorable risk to reward here in SanDisk. So let's look at a couple different ways to play this. So we're going to look right around that 14, we're going to look right around like 1470 or so. See if there is a favorable kind of risk to reward here within the options as well. So we're going to look about 30 days out. That's really when that time decay kind of kicks into high gear. And the level that we were looking at, I think we said 1470 or so. Is that 1470? Let's see. Yeah, 1470, 1460 or so. So we're going to look at that and we're going to see if we are able to capture a decent amount per the risk that we're going to take on. Okay. So we're going to look here. We're going to start, let's start at the 1450, kind of where that gap was. So if we buy this option here and we press our control key and sell the 1460, this could give us a credit of possibly $4.55. This is the 10 wide spread. Keep in mind that we do the same math as we did before, where we could be able to capture about $455. Our downside would be about $545. So that just the difference between the spread minus what we're collecting. Now, again, you're going to see a lot of volatility in SanDisk because of the level of volatility that they currently have. It has an elevated percentile, but this is why you're getting, as an option seller, a little bit more favorable return to risk, just because you have those elevated levels of volatility. So just keep that in mind if you were going to place a trade similar to this. We keep our premium if the price of the stock by expiration stays above 1460, okay? Now, if it breaks that support and closes that gap, that's where we would probably want to get out of this trade. So even though we have our risk managed to that $545, we could still say, hey, we want to close out this trade should we break that level there of support. Okay. So we're going to put this in, we're going to put this in our price patterns class, and we are going to hit send. Okay. Any questions there, you guys? Any questions there? I don't think we have time for another trade, but what we can do is take a look at some technical levels that are forming within some of the trades that we already did place today. So let's look at Google. So Google has earnings, I believe, after the bell today. And remember that we did place a trade in Google last week. I'm going to show our orders here so you guys can see those. We're going to show the orders. And so we are looking at this being a possible inverted head and shoulders forming at a bottom right here. So these are obviously the levels to watch going into earnings that traders may be watching. So we have that 375 up there as a possible neckline. We have these lows that may be down here. So should they get a negative earnings reaction, you may see this possible pattern fail and may move down to these lows, which would tell us that, hey, this may be a little bit more prolonged downtrend, because all we're looking at on this formation is the lows and the highs. Are we making higher highs, higher lows, or lower highs and lower lows? And so far we've put in a higher low. So that could be telling us that we may be getting this change of trend really soon. So we're keeping an eye on that neckline right around 375. So remember, our stop order only triggers during market hours. So if there is a positive reaction, we would have to wait till tomorrow's open to possibly get a fill on that order. Now, another pattern that we are seeing in a stock that I believe also has earnings after the bell today, we are seeing a consolidation pattern in Tesla. Okay, and let's see what time. I believe it's after earnings day. Yeah, or after the market today. So we're seeing that. So if we look at this possible pattern formation, we are looking at these lows that have been carved out as a level of support. So we can see that and draw that line. We can also see that we have had lower highs. So we can see that there's some type of triangle consolidation forming. So this seems to be a crucial level of support here. So if there is a positive earnings reaction, which we have had a bullish Harami here, possible bullish Harami, right here at support, that could be a reversal. It's not going to confirm until you see a close above this candle's high. But if you do see that confirmation of that bullish Harami and you see a little inside day, so there's definitely quite a bit of volatility compression here telling you that this could be a reversal, at least a pause. You could see that Tesla could rebound to the upper end of that range and possibly break out to the upside. But if it cannot hold here and we do have a little bit of a negative earnings reaction, well, you may have this zone right here that was a former gap that never got closed. Well, it was closed by trades, but price never closed beyond that level. So that could be another area that price could retreat to. So a couple things to kind of keep in mind. We always like to end this class with a couple price patterns, how to find these stocks. We are actually going to go through that in a class here soon of how to find some of these stocks. So basically what we do, or what I do in this case to find stocks for this class, is to create a very simple scan and look through a ton of charts. So everyone kind of wants the secret sauce to certain things. There's definitely ways to narrow down your universe, but the best way to find the best patterns and to get a really clean pulse on the market is going through a process of looking at a multitude of charts across sectors, across industries, across equities in general, and get a pulse on what's going on in the market. So we'll go through those that in a further webcast there for you, Wiley. And let's see if there's any other questions here. Okay. Awesome. Well, Mike has been a huge help in the chat today. So give Mike a huge shout out. Thank you to him. Thank you to the guys behind the scenes. Please give Mike there a follow on X. He's Mike Fairborn CS. I'm also Rachel Dash CS. This was how to trade a failed pattern or ways, and I'll see you later, traders.